Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Australia's banks remain pretty resilient in the face of global uncertainty and tension. The major banks had a combined $15.3 billion in profits for their mid-year earnings, a relatively steady result, but competition in the market may be squeezing margins. Noel Williams is PwC Australia's banking and capital markets leader. Noel, welcome to Fear and Greed.
Hi, Sean. Thanks so much for having me.
So we've had three big banks in the last week. We had Commonwealth Bank, which has a different end-year date 3 months ago. What is the prognosis for Australian banks broadly?
Well, interestingly, Sean, the prognosis is actually quite flat when we look at the key ratios that we look to see how our banks are trending in their overall health. But, just saying that they're flat is actually not telling the full story and the immense effort that has gone into just maintaining a steady state.
So let's go bit by bit. On the revenue side, different banks obviously focus on different things, but it's mostly mortgages and business lending. A lot of focus on business lending. In fact, they all seem to be saying that we're going to become the best business bank lender because that has a greater margin.
Yep.
What are you seeing on that revenue side, top line?
Yeah, so top line revenue is up. And what we're seeing is that there has been a real focus on the mortgages side to chase better margin. And that's a shift to proprietary lending. So to try to bring back some of that margin that was lost in that commodity trap of the mortgage head-on-head competition that we saw over the last sort of 18 to 24 months. And then on the business side, yes, everyone has pivoted towards business, and that is to try to find some of that better margin. But of course, as everyone pivots towards that and competition increases, we are starting to see maybe some early signs of price competition in that segment as well. Interestingly, I think in the business segment as well, we're seeing that system growth outpaced the majors. And so there is competition coming from the non-majors as well in that segment.
So just explain that. And we've had private credit people come onto the show and talk about how they've been able to step in, not always because of the individual banks' faults, but sometimes it's APRA. The regulator has made rules that makes it difficult for the banks, etc. But just explain how that business banking segment is expanding, at least in terms of providers.
Yeah, so when we talk about system growth, we're actually talking about the APRA-regulated system itself. So that would be your non-major banks. And we've certainly seen a lot of focus from the entire banking sector into business bank. And I think what we're seeing in the non-majors category is a focus onto particular subsegments of the business industry, so into SME or even specific segments of SME. So it's fragmenting that business market, and everyone's trying to get their niche and their offerings to really attract particular segments where they think there might be opportunities for growth. Now, the private credit side of that equation that you're referring to, that's not even measured in the statistics that we look at from the system. So that's, again, bringing additional competition into that space, but it's also filling a need where our stringent macroprudential settings that we have in Australia, which gives us this very unquestionably strong capital base, which is serving us well. We can chat on that later. But because we have that, the private credit space does fill a bit of that gap to balance out the supply and demand around the lending needs of those that don't meet those credit hurdles to get through with the banking sector itself.
Okay, I mean, just to finalise that point without talking about any specific bank, it's interesting that the non-majors seem to be doing a really good job in business lending when the majors are all attacking that as a way to improve their profit margins.
Yeah, correct. Well, I suppose it's probably just a factor of when everyone's focused on the same segment, that everyone's trying to find their niche to get into. I think if you're smaller, you can probably be a little more nimble and a little more targeted because you're not facing into the sort of scale of growth that the majors would be seeking. But certainly the majors all grew in that area as well. So, you can see those strategies starting to come through. And I think the real challenge now going forward is where we talk about that they need to strike this balance, is that trying to avoid getting into that price-based competition that happened on the mortgages front. And business certainly does give you more opportunity to differentiate in terms of the services, sector focus, et cetera, that you can, focus in on. And so we would expect that all of the banks will be starting to think about their strategies in that space and how they will differentiate themselves.
Okay, so the big banks, one of their big advantages is that when they want to lend out money, they actually get it from their deposit base. From your work, it looks as if it's a pretty good time for banks in terms of deposits.
Yes, deposits are at least in the last decade high as a proportion of overall funding. So that has reduced the reliance on the offshore wholesale funding segment, and it's really that domestic deposit base that the banks are chasing after to get into place. Now, I think if you think that through, it's not that surprising because interest rates are also quite persistently high. And so deposits are a nice place to park your money. And in terms of asset class, it's a very, very safe investment to have your money into the deposits. So whether that will remain or not as a funding mix as interest rates come off, we have yet to see. But, for this half, we're at an all-time high in the last decade for the deposits.
And on the cost side, PwC highlights the technology spend, and Westpac, for example, has a massive technology spend to bring its tech stacks together. Again, without commenting on any bank specifically, they all do seem to be putting money into that side of their business.
Yeah. So without naming any specific strategies towards that, but I think you see it in the commentary that each of the banks has their own approach to technology and investment there. But what is consistent is that the spend in technology and personnel is increasing across all of them. And look, it's unsurprising given the age of legacy systems that are being run, focus on operational resilience, the need to reduce some of that key person risk just to shore up operations, and then wanting to really simplify and streamline so that cost base can eventually be brought down and a real focus onto the front end and the customer and what that innovation can look like.
Stay with me, Noel. We'll be back in a minute. I'm talking to Noel Williams from PwC. Okay, so we kind of went through the ticks and tacks of the results before the break. A few things I want to talk about. Where do banks grow? Where is the growth trajectory for a Big Four bank?
Yeah, it's interesting, Sean, when we look at our banks compared to peers around the world, and this is, I suppose, one of the challenges for our banks when they're looking for those growth areas, they're less diversified than global peers, right? After the Royal Commission, wealth and advice arms were divested, and so you're left with a very standard set of products in terms of lending and deposits. And so what our banks will be thinking about is how do you grow in those traditional channels? Mortgages, we're seeing a real focus on growing in proprietary channels, so moving away from brokers and clawing back some margin there. And then as you look across the broader set of products and also looking at the innovation agendas, they will be thinking about how they can innovate to grow certain customer cohorts and segments.
That's a good segue into some of the work PwC has done on the different customer segments. Your analysis kind of picks up that Gen Z and millennials are 50% more likely to consider non-banks to provide banking services. That must put pressure on the big banks.
Yeah, again, it's a bit of a balance in terms of how do the banks focus. And there's a few factors that go into that, right? So that stat that you quoted there was from our global consumer preferences survey in banking. And I think that's a really interesting stat when you look at the younger demographics and they have a higher propensity to switch banks. They have a higher propensity to consider non-banks for banking services. And so they really need to be thinking about that next generation of customers and how do you get them now, make them sticky, and offering them those adjunct services that they're saying that they would like to see from their banking service providers. On the balancing side of that, you actually have quite an aging demographic in Australia, and that trend of aging demographics is forecast to continue quite steadily for the foreseeable future. So as we have a cohort of the population moving into the retirement phase, the superannuation releases actually become quite an attractive potential source of deposit funding. So again, our major banks looking at how to balance innovating for the younger demographic and yet retaining their more traditional legacy customers and meeting their needs in order to get that funding balance and mix right.
One final question. We always talk about Australia's banks being safe. 4 of the top 7 companies in the country, or 4 of the top 8, I think now, are the Big Four banks, incredibly well capitalised. Why are Australian banks, in plain terms, so not allowed to use the word capitalised, in plain English, why are Australia's banks so highly regarded?
Basel III.
Oh, that's not going to help us.
And that's a bit of a term, isn't it? Yeah, sorry. So Australia is actually world leading in terms of our macro prudential settings around capital that must be held by our banks. And so what that means is that for every dollar lent out, our banks are holding a very high ratio. And so therefore they're seen as incredibly safe in that space because there is a buffer there to absorb potential losses if there was a downturn. And you actually see that come through with investment trends very recently, since Liberation Day, that there have been overseas investment inflows into Australian banks. And so it's really just reinforcing that the banks are seen as a really safe investment, banks in Australia specifically, and that those macroprudential settings are actually serving us really well during these really volatile times.
Now, apart from the phrase macroprudential settings, I think you did a pretty good job. So basically, the regulator forces the banks to hold enough money aside, to actually hold them in pretty good stead.
Yep. And ours hold more than the others around the world.
Great. Noel, thank you for talking to Fear and Greed.
Thanks so much.
That was Noel Williams, PwC Australia's banking and capital markets leader. This is the Fear and Greed business interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.